historic ascension to the euro area. And to put his team in perspective, since he joined the central bank leadership in 2000, Croatia has seen 4 presidents and 7 prime ministers come and go. So it seems that politicians change, but the central bank endures in Croatia, which is an incredible feat and measure of stability. Besides being a very deep economic thinker, I want to share an anecdote that my friend Ricardo Lago told me about Governor Vujčić. And this is one time Ricardo was seated with him, and the governor received a phone call. And the phone call, if I'm correct, went like this. It was like, no, 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 yes, no, 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 and then hung up. And Ricardo asked the governor, is like, was this the finance minister? And the governor nodded. And Ricardo asked, so what is the yes? And the governor said, well, he asked me if I was listening. So that's a very good one. I would like to know what was the no's, but maybe that's for later. Now I'll introduce you to Professor Felipe Larraín Bascuñán, who served as a Chile Minister of Finance under President Piñera, guiding fiscal policy through post-crisis recovery and structural reform. Professor Larraín co-founded and directed the Center for Economic and Social Policies at Pontificia Universidad Católica de Chile, and has advised the World Bank, IMF, Inter-American Development Bank, and many other institutions. Early in his career, he collaborated with Harvard professor Jeffrey Sachs, helping understand inflation and debt defaults across developing nations. But also another anecdote from my friend Ricardo, Professor Larraín learned policymaking the hard way when he was working with one of these international organisms, had to go to a country and present a plan. And usually, if you work in international organism and they ask you for help, you go and present not necessarily the best news. So he had to sit up with the general of the army and explain that they needed to cut the budget of the army in half. So the general opened a drawer, pick up a gun, put it on the table, and ask, gentlemen, do you need another coffee? So this, I think, is a good lesson that sometimes economic theory and economic policy are two different animals to handle. And I think Professor Larraín has handled it extremely well. Let me move now to our third panelist, Dr. Manuel Ramos-Francia. He is the director of CEMLA, and which serves as vital forum for cooperation among Latin American banks. Dr. Ramos-Francia has a Yale PhD and is one of Mexico's most respected economists. I had some soccer comments to make about Mexico and Argentina, but I know that's a very sensitive topic in Mexico. So I'm not going to say it. Professor Ramos-Francia previously served as Deputy Governor of the Bank of Mexico, Chief Economist at the Ministry of Finance, and Director General for International Affairs and Central Bank. He has published extensively on monetary policy, financial stability, and macroeconomic management in emerging markets. Also, we have Dr. James Bullard, who now is the Dean of the Mitchell Daniels School of Business at Purdue University, but many of you know him from his more than a decade-long tenure as CEO of the Federal Reserve Bank of St. Louis. Dr. Bullard was widely recognized as one of the most intellectually rigorous and independent voices in U.S. monetary policy, particularly for his work on expectation-based macroeconomics and his thought leadership on the future of central banking. He bridged academic research and real-world policymaking at the highest level and remains a frequent contributor of global policy discussions. And guiding this exceptional ensemble of economists as our moderator is my friend, Professor David Andolfatto, Chair and Professor of the Department of Economics at Miami Herbert Business School, with a distinguished career spanning academia and central banking, including as senior vice president at the Federal Reserve Bank of St. Louis and special advisor to Governor Christopher Waller. David has co-authored influential work on monetary theory, banking, and the frontiers of finance. Notably, he was among the first central bankers to study and start talking about Bitcoin in 2014, when Bitcoin was around $500 and was not a thing. I hope you bought an hodl, that's the word, hodl, at that time. And he called at that time Bitcoin a stroke of genius in one of his articles, demystifying digital currency long before they become mainstream. If anyone can navigate a panel of traditional monetary wisdom with the disruptive potential for tomorrow, is David for sure. So here we have 5 extraordinary economists about to give you all their knowledge. So we are very grateful for all of you to be here. Please join me in giving them a big applause and coming here.
Let's see, is this me? All right. Well, good evening, everybody, and thank you, Alex, for those introductory remarks. I didn't realize he was so funny. Our session today brings together a distinguished group of policymakers, as you know, whose experience span the United States, Latin America, and Europe. Gentlemen, each of you has steered policy through episodes of fiscal strain, persistent inflation, and now a world economy fragmenting along geopolitical lines. So in this panel, we're going to ask, how do these forces constrain or possibly reshape the way central banks and fiscal authorities conduct policy? So I'll begin with a few directed questions, and then we'll open the floor for broader exchange and audience discussion. So setting the stage here, the global outlook. Oops, no, I don't need that. Sorry. I don't need. Each of you operates within a distinct institutional and geopolitical context. Looking ahead, I guess the big question is, what keeps you up at night? Okay, is it persistent inflation? Is it the risk of fiscal dominance? The rewiring of global trade or capital flows, or is it something else entirely? Why don't we start at this end? Boris?
Thank you. Thank you for inviting me first to the panel. I don't think that really. First, I would like to say that, as we say as a ECB, this is our narrative these days, that we think that we are in a good place. So we feel like we have kind of done our job, and that we did it in a way that was probably not expected by most people 2 years ago. 2 years ago, when I talked to the academics, when I talked to the bankers or to the private corporate sector, and we do these meetings regularly twice a year with all of them in the ECB. Most of the people thought that bringing the inflation rate from double digit down to the target to 2% would entail bringing the economy into the recession. And they were calling what eventually happened, the Goldilocks scenario. In the end, the Goldilocks scenario materialized, and we're happy that with a very low sacrifice ratio, we are at the moment in Europe where we want to be at an interest rate of 2% and the inflation at pretty much the target. What are the risks? What worries us at all the risks for the inflation, both on the upside and the downside? But I would say that what worries me probably more these days are some of the things that Mario mentioned in his presentation. One is the risk of fiscal situation. getting out of the control. One thing that Mario showed is that the Eurozone public debt to GDP is pretty much constant, as well as the deficit, and is forecasted to remain pretty much stable over the forecast horizon. However, one should not forget that in Europe we have a heterogeneity among the different countries with different fiscal deficits. So it's not like looking at the US, which has one fiscal deficit, one public debt. And the problems that we had in Europe during the Eurozone debt crisis were those that were a consequence of this heterogeneity, where different countries get into different situations at some point in time, and then you require policies to adjust. The good thing, again, the lesson from the Eurozone debt crisis is that those countries that got into the problems in the end, one of them is Portugal, but there are others. There is Greece, there is Spain, there is Ireland. They all did well. So that shows that, pushed back to the wall, you will eventually do the right things. The other risk is obviously financial markets. It's interesting that in this is one of the panels that have participated recently, where people talk about the stretch valuations, etc., etc. However, the market still goes. After each panel, usually market went up. This week we saw the correction. But I do get worried usually when I see the price to earnings, which are higher than my age, or I see the price to expected earnings, which are higher than my kids' age. It's worrisome. And if you look at all the indicators, you look at the Buffett index of the valuation of the market, it's pretty much double the historical average. You look at the K, it's double the historical average. So it's not like 20-30%, it's a double. So one worries, and particularly when you see that over the last 12 months, retail has done better than the hedge funds. And I remember, I'm old enough and I've been in the central banking for long enough to remember that the retail was better than the hedge funds. That's usually a sign of something coming up, which usually is not very good, because when retail invests into what they do these days, they go to the passive funds, ETFs. They don't know what they are invested in. They look at the monthly economies, they get more money, the market goes up. Those sellers got paid because of retail who came in, but at the moment when it starts to go down, often when they see the economy going down, they pull out of the market and it's free fall, and that can lead to many stability risks. The problem is that exactly what kind of and mechanisms for which they will be triggered. Traditional banks, some estimates put it at central banks' assets, but we don't know exactly how much and through which channels. So I hope we don't have to find out what kind of risks are there.
All right. So elevated asset valuations, Felipe, fiscal conditions in Latin America, Chile in particular. What keeps you up at night? What do you worry about?
Well, first of all, thank you very much. I'd like to thank this invitation. I'm honored to be here. David, Ricardo, pleasure and thanks for the organization of this a great conference. Let me just, before starting, say one thing. I was deeply honored, even more honored than being here when I was compared to Lionel Messi. I was extremely honored. And I think it was too generous, and I would be very honored to be called the Alexis Sanchez of soccer. In economics, but so that's to continue with the soccer tradition. Let me just take your question, David. There are four issues on my mind that keep us up. In a global economy, and Chile is, and many countries in Latin America are very highly integrated. So what's happening in this country is very relevant to what's happening in our countries. The first is the economic fragmentation, the protectionism, and the erosion of multilateral trading system. I think that is a very significant issue that's happening, and we don't really know what's going to happen, with this. What are the next, trade agreements that are going to be formed? By the way, I was going to refer to one of Mario's points. Mario says, the trade, regional integration and even bilateral trade agreements. I happen to come from a country that has trade agreements, free trade agreements with 65 countries. This is a record. We have over 95% of our trade going to countries with which we have FTAs. The only country that has violated our FTA is the US. Has placed tariffs, 10% tariffs on us. Even if we have a deficit with the US, we have the deficit. And we had we thought this was for countries that had surpluses with the US, but we had a deficit and a free trade agreement, and we were, anyway. So I think this is one issue, and this complicates monetary policy for these reasons that have been discussed. The second is the artificial intelligence bubble, AI bubble. I think that's one of the main risks that we have right now. And bubbles, they exist. And for those of you, there are many students here, I would suggest a wonderful book that was for me when I was a student. I really enjoyed Charles Poor Kindleberger's book, Manias, Panics, and Crashes. And you start from the tulip crisis, the Dutch tulip crisis, and you know that this crisis exists, and we are at a point where we have to analyze what's happening. You say, well, let's say AI crashes the market here in the US, that spreads all over. So that is one important issue. I would also place one other thing, which is the erosion of central bank autonomy and independence, particularly in the main economy of the world. The fact that that a member of the board can be fired. That there is a movement to remove the president of the Federal Reserve, and that is bad news. And I think it's not just bad news for the US. It is bad news for the US, because suppose that this eventually happens, that central bank autonomy is eroded, and you have a person who is, they're a new federal bank governor that is closer to the executive part of the government, then, you're going to have looser monetary policy. You're going to have higher inflation, and that inflation will spread over. So I think that's the third. And my fourth and last point is the fiscal issue. Particularly after the pandemic, we have a big increase in deficits, debt burdens, and very few countries like Portugal in the world, Mario. I thought that Chile was one, but you did much larger adjustment than we did. And I think this issue is the fiscal space now is very limited. After this very large fiscal expansion, and when you see 7% plus deficit to GDP in the US, there are limits even to the US. And this figure that you posed there, the 143% debt to GDP, is certainly worrisome, because there is a point when markets, you can also have a run, even a run on very high value assets like US Treasury bonds. And in particular, if you antagonize one of the largest holders of US Treasury bonds, which is China, well, China may decide to move reserves to other, So I think these are some of the issues that concern me. But I sleep well.
That's good to know. Good to know. I know you find a way. Thank you very much for that, Felipe. Jim, would you like to weigh in on that question as well, please?
Sure. Thanks for having me. It's great to be here. So I'm generally bullish on the U.S. economy. I think it's, if you look at the current numbers, growth looks pretty good. I think that there are a lot of factors coming into play. A lot of the uncertainty of the spring has gone down. And so you're seeing a lot of good things in the economy. So you're asking me to start with risk factors, but I want to say, first of all, I'm bullish. But the main risk factor right now, I think, and I'm agreeing with the other panelists, is the nature of the AI boom. So I'm going to give you Jim's view of this. So when you listen to Silicon Valley, they will tell you that there's some magnificent thinking machine that they're developing and blah, 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 and it's going to solve all of the world's problems. Cure for cancer is 6 months away, and, all this kind of stuff. So I would say, I would put that into the hype category, because there's a very good and far more pedestrian story about the feeding frenzy that's going on in Silicon Valley. What you need to do is just think of Amazon as a profit stream, a huge profit stream based on shopping, internet shopping. You've got Google, a huge profit stream going out into the future that's based on search. And what else am I thinking of here? Meta, a huge profit stream going out into the future that's based on social media. So the problem is those are kind of quasi-monopolies. They're gigantic companies, and now they feel threatened. They feel threatened by AI and by OpenAI and Microsoft. So it's really these four players in particular. And for the first time, they could see that profit stream taken away from them and given to somebody else, probably OpenAI. So they're nervous. So what are they doing? It's battle of the titans, and they're all tripping over each other to invest faster in the AI technology, but not because you're going to solve all the world's problems, because those profit streams are sitting there and somebody's going to get them. And so this is a little bit, I think Wall Street has come around now to this view, and they're scratching their heads about this. That's why this is selling off in recent days. And I think that it's usually Silicon Valley is a winner-take-all game, right? So somebody's going to be the winner. Now, if you listen to them talk, they'll say, "Oh no, there'll be lots of choices and everything." But that's not really the way this works. These are network externalities. Would you guys use the inferior AI compared to a superior AI? No, you wouldn't. You're going to use the better one. So also, Silicon Valley tends to give things away, so it's hard to see where the revenue stream is coming from. So what's going on is they're building all these data centers, and I wouldn't mind building all the data centers, except that that's physical investment. So you have physical investment that doesn't pay off. What do you got? A hulking data center that's empty. So that makes me a little bit concerned, and I think that it makes me a little bit nervous to have our biggest firms and our most successful firms, and the only ones that are really driving the entire equity boom, because the other 493 stocks aren't really doing very much compared to those. So I'm nervous about that, and it could go badly. Nevertheless, I don't think it's actually going to go in that direction, but if this goes too far, you'll get something like Global Crossing. So you guys weren't alive when Global Crossing happened, but that was during the last internet boom. And Global Crossing wanted to correctly surmise that there was going to be a lot of internet traffic in the future. And they said, hey, we're going to lay cables and produce the physical infrastructure to handle all that internet traffic. And they correctly predicted that, but they built so much that they actually went out of business in 2003 because they overbuilt. And when you look at these data centers, it looks like Global Crossing. It looks like you got four entities that are really building like crazy. And the winner take all kind of tells you not all of them are going to be successful, and you're going to end up with some empty data centers here. So this is what I'm worried about.
Well, typical former central banker. I guess you didn't mention anything about the national debt. You're worried about the private sector. But
You're going to give me a later question, so I could wail about that.
Manuel, another Latin America, or let's see, from a perspective from Mexico, I guess, how do you see the things that keep you up at night?
Well, first of all, thank you very much for co-organizing this with CEMLA. We're certainly honored to be here. And well, we hope to initiate a partnership with you guys, because we think that we can have very, very good things coming out of this. So let me say that not just one thing worries me in particular, it's the confluence of various things that worries me. One, they've already talked about, trade or geoeconomic fragmentation, which is not only trade, but also financial fragmentation. We have geoeconomic events like war, very worrisome in the sense of the impacts that it can have. Fiscal imbalance is very important, but I would like to highlight two more, which for me are very worrisome. And also saying that, I say this, we have a saying in Mexico, which is if the US sneezes, Mexico catches the pneumonia. But I think it's not only Mexico, but many others. And I think that in that sense, even though there was a flurry of activity after the global financial crisis, I do think that there is some complacency setting in financial stability issues. I think that I would like to point out here a couple of things. One is very worried about the increasing interconnectedness between banks and NBFIs, non-bank financial institutions. I think that banks are increasingly providing liquidity and funding to NBFIs. I think that this interconnection, I think, can be, at least I can put three examples which are very worrisome. One is large complex financial institutions are overlapping in their interaction with CCPs. That's very worrisome. Two is they are creating these relationships between banks and NBFIs where they're optimizing their regulatory constraints. They're sort of like regulatory arbitrage, where their comparative advantage of banks is, of course, their liquidity deposit franchise and their access to a safety net. And in the case of for example, NBFIs, asset managers, of course, they have more savvy in terms of asset management and so on. So they're increasing their interconnection there, which is, I think, worrisome. And the third activity is the transfer of credit and synthetic risk. For example, in terms of the transfer of credit risk, banks are sort of like getting risk off their balance sheets and putting them in special purpose vehicles, which are managed by private credit firms, which again is creating interconnections there, which can certainly give rise to systemic risks. So I see a problem there. The second is the digitalization of finance. I think that we have to understand the digitalization of finance in terms of the centrality of data in these economies now, and that we have to look very carefully at all of these platform-based models, as James Bullard was saying, in terms of integrity and competition with respect to the use of this data. And I think that there are a lot of potential problems there. Mr. Bullard just referred to them as monopolies. Monopolies always are not a very good thing. And I think that there are a lot of problems there that we should think about. Also, in terms of the digitalization, just the technologies that are backing that, I think that can be certainly used and can improve in terms of inclusivity in countries like Latin America. And they can also improve payment systems. They can, for example, improve efficiency in terms of settlements and so on. But I think that, again, just in terms of other aspects of digitalization like cryptocurrencies, I think that there are some problems there that could be very worrisome. For example, I think stablecoins are runnable, and we have to be very, very careful with these. So that's worrisome in terms of financial stability. And the last point is I'm also worried about environmental degradation. But it's not only these risk factors. I think all of these risk factors are distracting the attention of the provision of a very important public good, which is global stability. And for that, I think it's distracting resources in terms of what should be coordination in terms of fighting pandemics, in terms of harnessing appropriately AI, also in terms of the adequacy of the global financial safety net. So I do think that there is more risk factors, and the confluence of them is very problematic, not only in terms of monetary policy, but in terms of where the world, the economy is going to. So that would be, now, just as Felipe Larraín said, I'm worried about this problem, but I can also sleep very well.
Very good. Thank you. So listen, what I'm going to do is I've got a bunch of other questions. I'm going to target the questions. I want to leave some time for the audience to ask some questions. So I've got one specific question. I'll target to Jim here. The issue of trade fragmentation was raised by Mario. And this is the specific question has to do with the disruptive effects of tariffs. So Mario mentioned the potential inflationary impact of tariffs. There's a debate going on whether or not central bankers should look through tariff effects on inflation or whether there's something more to it. Kind of curious to know your view as an ex-U.S. Federal Reserve president. What do you think is the proper way to manage inflation during this time?
As a general matter, I don't think tariffs are inflationary. The U.S. Trade Representative doesn't have an inflation target. It's the central bank that has the inflation target. So I think at a high level, I think that you wouldn't expect trade effects to be very large on the price level. U.S. Fraction of goods that are imported that are in the consumption basket, that's only about 10%. A lot of the early debate just seemed to think that, okay, well, the tariff goes on at 50%, therefore the price of the good on the shelf is going to go up 50%. You got a lot of talk like that. But come on, if you're running a business and you could just raise your price 50%, why didn't you do that before there was any tariff? You're in a competitive market. You've already chosen the price that you want. And then if you get the tariff, you're going to have to decide what to do. Usually, some of the analysis anyway comes out to the idea that the supplier takes on probably a third of the cost of the tariff. Logistics takes on another third of the cost, and another third comes to the final consumer. So if you think of it that way, there's only 10% of the goods that you're talking about. Only a third of the tariff eventually gets passed on. So you don't see that. So it's a pretty muted effect, and it's a one-time effect. You're changing the structure in that particular market. If you think of ketchup on the shelf, you've got the foreign-produced ketchup. It's going to be a little bit higher priced. People are going to substitute away from that and toward the domestic ketchup. Then you're going to get to a new equilibrium. So I don't think it's as disruptive as it's been portrayed. The other thing is that the tariffs themselves are bouncing all around. So it's actually very hard to calculate the effective tariff rate for the U.S. because there are so many exceptions being given. Tariffs go on, tariffs come off, new deals are made, new deals unravel. So if you're a price setter in the market, you're going to be very hesitant to say, well, I'm going to raise my price because of the tariff. And then you lose a bunch of customers because of that. And then the tariff goes away anyway. And now you've lost those customers. The cost of customer acquisition is very, very high. So the last thing that most of these management teams want to do is lose some customers over this issue. And so they're going to do everything they can to push off any price increases as far in the future as they can and cross their fingers that the tariffs might go away entirely on their particular good. And you can get exceptions. So all kinds of things going on in this environment.
Thank you. Do any of you want to push back against that view, or do you broadly agree?
No, yes. I think I agree with mostly with what Jim Bullard was saying. But this is from the point of view, first of all, this is from the point of view of the U.S. And second, it's not only tariffs. It's the disruption of supply chains, which some of his comments also apply to that. But from the point of view of small open economies like the ones in Latin America, if you put together, disruption supply chains, economic costs that tariffs imply, labor movement restrictions, a lot higher uncertainty, and so on, I think that central banks will be subject to a lot more in terms of frequency and intensity supply shocks than before. And we all know that these supply shocks are much more difficult to manage than aggregate demand shocks. And the net effect on inflation, it all depends on what happens with aggregate demand, because the direction of these supply shocks, of course, go against inflation, that is higher inflation and lower activity and unemployment. The net result is what happens with aggregate demand. You can have aggregate demand plummeting because of losses in efficiency, and those losses in real incomes, and those are more subdued aggregate demand, which would compensate some the pressures to increase in inflation from the supply shocks. But overall, I think that the more important prevalence of supply shocks that central banks in small open economies are being subjected to certainly can make their task a lot more difficult. This is very different than in the US. In the US, it's a relatively closed economy. We're much more flexible in terms of price adjustments and so on. They can certainly absorb some of these things in a much better way than some of these other small open economies. So I would be summing up saying that being subject to more frequent and intense supply shocks certainly can complicate the life for central bankers.
Thank you.
I would just like to say what we see so far as effects of the U.S. tariffs on the European exports to the U.S. So we monitor European companies' exports to the U.S. export prices. So what we see so far is that approximately 80% of the companies have not changed their prices exporting to the US. So it's only 20% that have, but not fully, some fully, but of the other 20, some partially absorbing the tariffs into their pricing policy. Now, I don't know whether the 10% in the US also encompasses the goods which are intermediate goods, or these are only final goods. But I agree that this will have it will have a one-off impact on the inflation, but it's not going to be one-off impact that you will see in any month. There was a lot of inventories built before the tariffs kicked in, and then a lot of that is still being used. And the rest will be absorbed either by the importers, or will be passed on to the consumers, or through the intermediate goods to the producers in the US. So I think it will have, I assume, more protracted impact on the inflation. You won't see it in 1 month, 2 months, 3 months. Maybe it will be 6 months or so until everything is full effect is absorbed. But in the end, I mean, from the economist's perspective, probably 80% of it will be a tax on the American consumer, one way or the other.
Thank you. I have a
couple of. I would agree with most of what James said, but I have a couple of points. The first point is, I saw a recent calculation that although this changes every day, as you say, or probably or every other day, the level of tariffs, but the level of tariffs in the US after April 3rd went to the highest average tariffs since 1930. Which is quite astonishing to me. The second thing is that we will all agree, I think, in this panel, that a tariff increase, except if it goes on and keeps increasing, is a one-time effect on prices. But so it's not an increase in inflation unless that effect is accommodated by the central bank. Because if it's accommodated, like it happened with the supply shock of the 73, 74, the oil price shock was accommodated in many countries, and you saw an increase in inflation. And you can say, well, it's just relative prices that move, but in the end, we had high inflation for several years, or for at least a couple of years. The other part has a lot to do with one point that Mario made in his presentation. It's about the issue about elasticities. How is it absorbed? And I recommend there is a paper produced on a weekly basis by a couple of professors at the Harvard Business School that calculates the effect on US consumer prices of the tariff increase. And it's updated every week. So it's an interesting paper. One is the son of Domingo Cavallo, who is a professor. I think it's Alberto Cavallo, who is a professor at Harvard Business School, and the other is a co-author. I think it's interesting. And what it says is that although the effect is small, you're seeing an effect on US consumer prices. And probably what's happening is that it is exporters from other countries that are taking the biggest part of the hit, on their margins. So margins are being reduced, but at the same time, there is a very interesting effect in third markets. What's happening to countries that lose, that lose penetration in the US market and that lose access to the US market, they shift their goods to other markets. So we are all feeling a bit of this in increased exports to our markets, all meaning the rest of the world, not all because we're in the US, so most of you are not feeling the effect, but most of the world is feeling that. So it's a very interesting global, I would say general equilibrium effect on trade. And it will imply changes in the way the world trade, world trade system operates, but also, and I did it here because it's a big issue, will this be just a transitory issue in the US? Or is it more of a permanent change in US trade policy? So, meaning after President Trump, who is on his second term, what will happen? Will the guy that comes in, undo or not? And probably part of the answer that I would get, it is very difficult to undo this.
I think the answer is it's a bipartisan consensus. So there's no indication that either party will retreat from the more intensive trade policy.
So let me conclude with one final question, and then I'll take questions from the floor. And I have several other questions, but let me focus on the fiscal situation. Many countries around the world are finding their fiscal situation, it looks troublesome, at least on paper, debt to GDP ratios, deficit to GDP ratios. Not all have been as well performing as say, in Portugal, and I suppose even Chile. How do you do this, without imposing some form of austerity? It sounds like this is the payment necessary. I think Manuel mentioned that much of the spending is non-discretionary. Jim, in the United States, how the United States, of course, is in a special position in that the U.S. Treasury is the world's global safe asset. So the fiscal capacity for the United States is potentially much larger on an ongoing basis. But there must be limits to how much debt the Treasury can issue. So the question is how is this to be done? What lessons can we learn from the countries that have been successful? And what sort of barriers are there to getting the fiscal house in order in some other countries? Well, we start at this end.
Which is, I think that Latin America is sort of like the textbook case of fiscal dominance. Happened in the 80s, 90s. We still have one country dealing with that. And I think a very important issue here is that depending on the shape of the demand for money curve, you can have with the same fiscal or with the same monetary injection, that is, if you are funding or financing your fiscal deficits through the inflation tax, you can have dual inflation equilibria. Manuel Williams here has done some work on that. But the very important part here is that sort of like a demand curve that results in a lateral curve for the inflation tax. We see here that the same net monetary injection can lead to inflation equilibrium. In usually these economies where the fiscal accounts have been in a lot of trouble, they are stuck in inflation equilibrium, so that you retrench. So the things even worse in the setup that you gave, even if you retrench, there are in the economies taxation mechanisms, which make it very difficult to go from high inflation equilibrium to a low inflation one. You have to basically coordinate the whole system, the fiscal accounts, but also coordinating wages, prices between workers and the private sector entrepreneurs, and also, of course, monetary aggregates, and you have to float in terms of the exchange rate, because you see, as Argentina is saying, you get immediately into trouble because usually the inflation in the variable sector will be higher than in the variable goods sector. So this is absolutely terrible. It's very difficult to get out of a high inflation equilibrium, which is usually very stable. So my point in this is be very careful with this. Not by correcting your policy finances. If you go through other policies, very difficult to get out of high inflation equilibrium.
Jim, U.S. fiscal situation, does it worry you as a central banker? Would you be looking at 7% deficits? Are we looking at? Is it close to?
Kind of steep. So in my role as provocateur, I will throw out another novel theory here. So I think we need more research at the intersection of trade policy and fiscal policy. And, I'm going to give a version of argument Ed Phelps made a long time ago. He's a Nobel Prize winner in economics. So you have a tax problem and you have a bunch of tax instruments in front of you. And so you need to raise a certain amount of revenue. And, should you maybe forswear some of the tax instruments and only use some of the others of the taxes, or should you use all of the tax instruments, or what should you do? And the answer is, if you work out some theory, that you should take the marginal distortion from each tax and equate it across the tax instruments. So, well, wait a minute now, tariffs are a tax, so why shouldn't we use taxes, or tax revenue gained from that source? Of course, it's going to be distortionary to the equilibrium. It's going to be a bad thing. We're not going to get to consume quite the same way we would otherwise consume. But that's all taxes, labor taxes, all kinds of capital taxes, all kinds of other taxes, also distortion. So what you should do is, Phelps said, you should equate across these different tax instruments. So this argument has not been made in my career until now, I guess. It has not been made in my career. It was always the sort of the Reagan era thing was, look, we want total free trade globalization, and we're going to not raise any revenue or very little revenue from tariffs, and we're going to put it all on the income tax and progressive income tax and other things. Okay, but I'm not sure Phelps might have been right about this, and now this is coming back to the fore. And so what has happened is that through the back door, President Trump found a way to raise some tax revenue, which is going to offset the fiscal situation. And it's not a small amount, it's quite a bit. And is that a good thing or a bad thing, or how should we think about that? So I'd encourage the students in here to, graduate students especially, to think about that and maybe work on that, because I think that's an important argument that has been ignored in the literature that I'm aware of. Now, don't get me wrong. There's nothing wrong with the free trade theorems. The free trade theorems are telling you you should allow voluntary exchange. You'll get the best allocation of resources. That's totally what you should do. But this is a second best problem where you have to raise a certain amount of revenue. And you have a revenue source here. So the Republicans, famously anti-tax, have found a backdoor way to raise some tax revenue, and that's going to mitigate some of the, in combination with growth, might mitigate some of the fiscal deficit problem.
Well, we'll see what the Supreme Court has to say about that, I guess. But take it away, Boris. What do you think?
Well, first, there are some things that I think about what Jen just said, but let me first say to your original question, Croatia, let me also mark it, my country, has reduced the public debt to GDP by 30 percentage points in 4 years. So from 21 to 24. Yeah. So from 87% to 57. So it's doable. There are two things which are important, I think. You have to use good moment. What's the good moment? When the growth is high, A, and B, when the inflation is high. So you take the inflationary revenue, you don't index all your expenditures, or you index them at a lower level than the inflation, and the debt comes down very quickly if you have some growth. So it's doable, but you need some of these components. If you have no growth, no inflation, it's very painful. It's still doable, but then you have to cut nominal spending, which is politically very difficult for any politicians. On what you just said, I agree. It's tax. I mean, if you have a deficit of 7% persistent, you have to find tax revenues to cover that, and your debt is going up. So this is tax, as I will repeat, mainly on the Americans that will, cover that that's deficit. But that will not be enough, I'm afraid. If you do also simple calculation and you see the trajectory of the debt going up, I'm afraid there will be other taxes that will have to go up in America in future. And there is space. I mean, you are a low tax country. You can raise taxes, but some of the politicians in some election cycle will have to just say, look, we have to raise taxes because the amount of the GDP that goes for servicing debt is such that we cannot do it anymore without raising the taxes. And it won't be tariffs at that moment. It will be other taxes.
Thank you, Felipe.
Yes, this is a fascinating argument, and James, I think you have been very kind to try to put, trade policy of the U.S. in Edmund Phelps, paper, where he actually, and there are many students here. This was a very famous discussion. Phelps responded in a way to Friedman, because what Milton Friedman has said is that the optimal rate of inflation was negative, and this was a partial equilibrium view of just money demand and money supply, the marginal cost of producing money. So the interest rate is zero because the cost of creating currency is zero, and then then you should have the nominal interest rate being zero. To have the nominal rate being zero, you need to have a negative, nominal negative interest, because the real rate is always positive. Anyway, famous discussion. My view on this is that conceptually absolutely right, that you should not constrain yourself not to use one tax instrument. So I would completely buy that. On my view, this is one of the most disrupted taxes that you can have. So probably on the loss function, the level will likely not be zero, but would be minimal, in this general, social welfare function whose loss you're trying to minimize, subject to a given amount of revenue. So that would be my take on that. But my final point is one in reaction to Manuel. Manuel, when you say, yes, we have inertia in the economy, so it is somehow difficult to bring down inflation, but there are many countries that from the height of the inflation at the time of the pandemic to now, you have had a reduction of rates. In my country, Chile, we went from 13%, we are at 4% right now, 2 years later. In the US, you were over or around 10, and you are now at around 3%. So I would say there is, and the critical issue for me on the monetary side is to have an autonomous central bank, a monetary rule, and inflation targeting. And absolutely agree with you that it should be flexible exchange rates, floating rates. That's part of the combination. Never try to do these days, fixed rates, unless you're a country that is too much tied, you're a small country, you're tied, for example, to the US. But my last point, and this is truly my last point, is that you have fiscal austerity is not sufficient for fiscal credibility if you don't have fiscal rules, if you don't have fiscal institutions. By fiscal institutions, I would propose four, which I worked with them, and one of them, during the time I was finance minister, we pushed for the introduction of and the deepening of the fiscal balance rule, structural fiscal balance rule. Second, sovereign fund that you can take in and out, when in good times, and so you can really do countercyclical fiscal policy. Third point that I would say is an autonomous fiscal council. This should not be a resolutive council. It's an advisory council, but in our country, at least, and there are many countries that have these fiscal councils. In our country, it is so prestigious that when we discuss the main reform to pensions in 20 years or in 15 years, the senators would not vote unless the fiscal council will provide a written opinion about the social security reform. The last point of this institutional framework is a medium-term fiscal framework, on the fiscal institution. So those four, to me, are the.
Well, thank you very much. Is it okay if I open up the?
Yeah, let me just because it's very important what Felipe just said. But no country in Latin America, of the bigger economies, with the exception of Argentina, is under fiscal dominance now. They are not stuck in high inflation equilibrium. So, of course, if you don't have fiscal dominance, you are in low inflation equilibria, and thus your monetary policy is effective. And you can, after this type of shocks that they have undergone, that you go back to a low inflation equilibrium. And I would like to make one very quickly additional point, which has to do with political economy more than economic policy. The big question is, and this is the way I was also at the Ministry of Finance, and usually when there is a need for retrenchment, for economic stabilization, and you see many countries announcing, we reached 5 points of GDP, 7 points of GDP, and so on. You have to be very careful what you are cutting. And the question is, can budgetary cuts be inflationary? And the answer to that question is yes. Because usually it's very difficult to cut, as Mr. Vujčić was saying, programs like pensions or wages or whatever. What is usually much easier to cut is investment. But investment is usually self-financing intertemporally. So if you do cut investment, your public finances will be affected in the future, and they can be inflationary. Thus, you have to use inflation tax to compensate for that. So this is a very important thing. The budget management has to be very careful. We have to cut, but you have to be very careful in what cutting public investment. Thank you.
Thank you very much, panelists. I've got a microphone here. Who wants to ask some questions? I'm going to go back first.
Hi, my name is Ezra. I guess my question is, since President Trump's tariffs, there's been a lot of negativity, but the market's been hitting all-time highs. So my question is, what's the correlation between the tariffs and the market?
Tariffs and the market. So, when the tariffs were first announced in force on April 2nd, there's a huge sell-off in the market. And I think was actually already mentioned here, that level of tariffs, that would be as high as Smoot-Hawley tariffs. And the Smoot-Hawley tariffs were in 1930. And at that time, the U.S. raised tariffs a lot, going through the Senate, actually, and voting it in. The President Hoover wasn't clear if he would sign it, but he did sign it. And then other countries just retaliated with very high tariffs as well. So roughly speaking, you got the worst outcome. You just got high tariffs all over the place and less global trade. that's considered a contributing factor to the Great Depression, but not the decisive factor for the Great Depression. So I think people were very worried in April that you get something like that. You'd get the US going very high, and then all the other countries would just say, we can't deal with these guys, we're going to go high too. And then you'd have very high tariffs, you'd have collapse of world trade. So that markets were pricing that in April and May. That isn't the reaction that happened around the world, to the credit of many countries around the world, except for China. China did try to retaliate immediately, but eventually China was pushed to the back burner. And the other countries were much more careful, I think, in their response, and managed to play the situation down a little bit. And that's basically where we're at. So you got this big sell-off and then a big rally. The rally is also being hugely impacted by the AI component. And as I was talking about earlier, it's really the seven companies that are basically the mega tech companies that are driving the equity market. It's not totally that, but that's a big chunk of it. So you've got this ongoing, I described it as a feeding frenzy around AI and a feeding frenzy around these data center construction, because each of those firms has to show that they're in the game and that they're going to do it. And in order to show that to the market, you actually have to be committing to build or actually building physical facilities, highly specialized physical facilities that do not have a known demand yet for any product. So that's why I'm a little worried about the growth being driven partly by the AI, but the AI could collapse and then the fiscal situation would get worse. Everything else would get worse. So I'm a little nervous about that.
So, hello everyone, I'm Federico Garcia. I wanted to start by saying that it's an honor to be here with the dream team of governors of central banks and great economists. And I want to take advantage of that to ask you the following question. I think anyone can answer this question. I already know Mr. Boris's Vujčić answer, so anyone else. It's crazy times where the biggest promoter of multilateralism, which is the US, has sort of shifted from the Bretton Woods Foundation. I just want to know and hear your thoughts on the future of the dollar's exorbitant privilege, and like Mario Centeno said, the need for a second Bretton Woods. So thank you.
Who wants to take that? Go ahead, Manuel.
Where is here? And again, this is from the point of view of an economy like Mexico or other Latin American economies, which is a combination of two things: some erosion on the exorbitant privilege of the US, that is on its role of the reserve currency, and fragmented together with more fragmented capital markets. That certainly leads to less international risk sharing, both in terms of quantity and quality, which probably will yield a lot more volatility in terms of interest rates and in terms of inflation, expected inflation in interest rates and exchange rates, which complicates monetary policy. I think the most important part here, again, is that for asset pricing, in general, we do get a risk-free rate. And it seems like there are some things going on that perhaps the US is losing some of that, or at least by some actions, it sort of like wants to lose some of this, which I think will have very important repercussions in terms of the stability of the global financial system. Hopefully, it does not go that way.
Can I add one thing to Federico's question? The exorbitant privilege has been conferred to the US dollar by the markets. The exorbitant privilege can be taken away by the markets. And I think the markets are being, more nervous about what's happening here, because one of the great things about this country is that, and as you said, I spent 10 years of my life here, as a student, as a professor. I've lived here for a long time and consider this my second home. But one of the great things is the institutions. So if you, in general, U.S. Federal Reserve, if you're the head of the U.S. labor statistics and you provide a figure that is not liked by the government, you get fired the next day. That's not good for institutions. Sorry to say, but I don't think it's good for the institutions. So my whole point here is that this is a great asset. The quality of the institutions of a country is very tough to win. To have that quality. It's very easy to lose. So I just point out, I hope that this erosion that we've seen is just transitory.
I just add one thing to what you said. It's true, it's the markets mostly, but it's not only the markets. If you think about what different countries at the moment are trying to do to get away from dollar and the payment system in dollars, that's mainly related to the sanctions. You would see that the different types of payment systems are developed. So you have a fragmentation of the payment system, which is basically not market's decision. It's a sovereign political decision of different countries. And you also have a flight to which was always difficult to do, but you see how the gold price went up. This is consequence of the fact that some of the countries also tried to get out of the dollar into the different other type of assets, which they can find. They cannot find that many of them, but over time they will. So this will lead to the more fragmented, I would say, financial system also in that respect. So it's not only markets; it's also much of the sovereign decisions there.
I would just say on the breakdown of multilateralism, it's just not the same world that it was in the post-war. And I think in that world, you could have the U.S. and basically very close European allies sort of laying the ground rules for the globe. But now you've got China. It's looking more and more like it was a mistake to allow China into the WTO. There's been no trend toward democracy in China at all. They've turned more hostile. They couldn't bring themselves to condemn the Russian invasion of Ukraine. They're talking about, military expansion. So that's not going to be a world where you can do multilateralism the same way that you could in the post-war world. So I'm not surprised it's breaking down. I do think it's bipartisan in the U.S., so it's not going to go away. It's a lot of these changes are going to be permanent, but exactly what's going to happen, I don't know.
Hi, guys. Thank you all for coming. So my question is, Tuesday, as I'm sure most of everyone in the audience saw, New York City elected a socialist to be its next mayor. So do you see this continuing as a trend, not only in the United States, but more so worldwide in terms of socialists or so-called democratic socialists rising to power? And how would that affect the economics of the world?
This is for all of us who grew up in the era of the 60s and 70s. You were all hippies. You should have seen the long hair, tie-dye t-shirts and bell bottoms. And now look at them. I think that's the answer to your question. But please, so go ahead.
Had a very left-wing mayor in Bill de Blasio, so I think this is Bill de Blasio too. I'm not sure they're going to be able to do very much different. If the left came to power, so the Bernie Sanders left came to power, I think what you have in the U.S. is one party wants to spend a lot and the other party wants to spend really a lot. So I think that's why the fiscal situation isn't so good, is because normally you would say that the other party would say, hey, you guys are spending too much on stupid stuff and you should vote for us and we'll get this under control. But that's not what's happening. It's going the other way. It's really so that part I think is a little disturbing, that you don't have at least somebody that can get elected. And who's the problem? It's all of us in this room. We're the people that are electing both of these parties.
Let me add some things from the rest of the world. At least in Latin America, what we're seeing is the opposite trend. In Chile, where you have President Milei, in Argentina. In Chile, you have a big turn from President Boric to, we don't know who will win, but we will win someone from the opposition. So that's absolutely, and it's either center right or half right. That's what's happening. Then in Colombia, President Petro will be succeeded by someone from the opposition. We don't know, but it will be someone from right or center right. And if you continue, there are many. Bolivia, just the elections brought to power Mr. Rodrigo Paz, a senator, a center right, Christian Democrat, on the tradition of the Christian Democrats in Europe. So I'm seeing the opposite trend. In New York, it's up to you to solve it.
Just add something very quickly to this. I do think that the extremes, at the end of the day, tend to meet. And it's not whether you vote right, and I'm talking more about Latin America and other countries, not the US. And at the end of the day, people are just fed up with politicians. If you look at the income inequality, you talk here in the US about the 1% and so on. You should see the situation of inequality, both in terms of income and wealth in countries like Latin America. And people are just fed up with this, with politicians to the right or politicians to the left. So they swing. Felipe just mentioned what is happening at the moment. But if you go back 4 years ago, just look what happened to the Pacific Corridor. Mexico went left, Peru went left, Chile went left, Colombia went left. Swing back to the other side. But it's not people getting tired with some kind of philosophy. It's just people getting tired with the politicians, whether they're from the right or the left. And they're getting tired because they're fed up with inequality, just fed up. So I think it's more a discussion, not about, left or right, but about give the vision of the country which citizens, not just a group of them. That's my point of view, especially what is happening in Latin America. I think that, as Felipe was saying, we expect this swing to the right. Probably things will, with the exception perhaps of Chile, but in most other countries, you will see a swing back to the left, just like you saw with Bolsonaro and Lula. And again, it's just such an unhappiness. Are so pissed at politicians. Way out. So I guess that it goes well. In the case of Latin America, it goes well beyond the question of being right and left.
Thank you very much. We have a question here from Morocco. Sorry. We've got to get some more questions in here.
Yeah, I just wanted to say that we don't comment as ECB officials politics. And I never did in my career. That's how I survived 4 presidents and 7 prime ministers.
We have a question here.
My name is Hamza. It's lovely to be in your presence. So I'm under the impression that, and correct me if I'm wrong, most of these issues we find ourselves discussing and trying to solve, whether it's through monetary policy, fiscal policy, or even through social policy, at the core is credit expansion, what seems like limitless growth in money supply, what we call now printing money out of thin air. And my question to you is, not as governors of central banks, but as economists, do you think there's a way to solve this issue or tackle it at its core instead of chasing policies that like solves our tails, I guess? And if you think that is the issue.
Jim, the United States seems to be printing money out of thin air. Inflation's still pretty low.
Well, we had a lot of success getting inflation down from where it was, so it's still not back at target. So I think for now it's a pretty good but not perfect policy. And labor market performance is also pretty good. The unemployment rate is in the low 4% range. That's very good by historical standards in the U.S. So I think the loss function for central bankers in the U.S. is actually probably about as good as it's been. So I think we're not in a situation where things are spiraling out of control the way they were, I think, in 2022 and 2023, but we were able to bring that under control. So
Thank you. Let's limit this to just one person. I want to maximize the number of questions that come from the audience. So,
hello, everyone. Thank you for your time. First of all, it's amazing to be hearing such a wisdom from experts. I'm a fellow Chilean and Bolivian, and I'm actually wondering what happens with our countries. Because, for example, when there's a mistrust in the U.S. government, maybe a takeover to the federal. What are we doing with the Fed and the U.S. government is not working? When we rely so much on the U.S. institutions, as in Latin America and even Europe, and when there is this breach, what is happening? What will happen in the future if we think that there is no trust in what is the base of the system? Thank you.
What? Come on, Boris. No, just I have a more optimistic view. I'm not saying that. Take more questions. So what?
please answer the question.
Okay, good. Good. Okay. Yeah. No. My whole point is that I think it's basically a warning against the loss of great institutions. Just a warning. And if some of you here in this room think that the BRICS could replace with a single currency the dollar, I think that will happen in another life.
Thank you.
Okay, thank you. My question is, what happened with political instability and basically social unrest and all that when we're basically testing the labor market as a resilience pillar in the current economy?
Who wants to answer it? Yes. Nobody.
No,
not sure I got it. So
let me try to, so it doesn't appear that you. When I discuss about, for example, AI with the people who are bullish on the AI and who tell me that the valuations are okay, one of the arguments that you hear is, okay, let's take the total wage bill in the US, which is, I think, around, what, 3 trillion? Total wage bill yearly?
2/3 of GDP.
Yeah, okay. And then you imagine that the AI will make 15% of that wage bill redundant because you won't need all those people. So then it's 450 billion that you needs to pay in wages. So, investment in the area of 360 billion, which we have yearly, is perfectly fine. If only 15% of that. But then your question kicks in. If you have to lay off 50% of the people from the labor force and these wages disappear, you don't have a reallocation, then you have a political problem which you have to solve in a different way. Now, because you're going to have some social outlets, etc. That's how I then ask them how they see that problem, and how that will emerge if after you lay off 15% of the people. But I mean, nobody of us knows how it will end up, whether 15% of the jobs will be less. We haven't seen it typically in the history that you just have jobs destroyed without being replaced by some other jobs. But your question in that situation becomes relevant. What if the labor market really feels the impact of the AI in such a way? What do politicians do? How do they address that question? But that's for another panel.
Thank you very much, Boris. One more question here.
Hello, thank you so much for the conference. It's been incredible to hear your guys' perspective. I'm Santiago, I'm from Mexico, and I want to ask, in your opinion, what do you think are the main challenges for economic growth in Latin America right now? Thank you.
So would one of you like to address that? Felipe or Manuel? Oh, okay.
Santiago, your question is very timely. We are growing in Latin America right now. Instead of converging, we are diverging from the world economy. Latin America is growing at about 2% per year, and the world is growing at 3% per year. So we have a gap of 1 percentage point just with the rest of the world, with the world. So I think this is a very important issue. And the reasons for this, I think we have one of the most personally insecure regions of the world. Personal security is an issue. It takes a very heavy toll on the economy. I think we have a lot of instability, people trying to change the constitutions very frequently in many countries, and that's a big source of instability, of uncertainty, instability, which has a problem of investment. If you look at the figures of TFP, total factor productivity, is pretty much stagnant or even declining in some of the countries. So I think there are many issues. There is also red tape. Bureaucracy, red tape, which is in my country to have a big project, a mining project. It takes about 11 years because of the permits. Since you start your investment, you ask for the permits, and this is something that we need to. And it happens all over the region, And I think these are just some of the issues. And in some cases, we have a dysfunctional political system, which we also need to take care of. So those are some of the main issues.
Just very quickly say there are things, but I think that there's an economist who has worked on all of this, and I think he's dead on with something already. And I think one of the central problems in Latin American countries is the asymmetric treatment in the market of the formal sector and informal sector. And this gives rise to terrible distortions. You basically tax and you basically subsidize the informal sector. So it gives rise to productivity, which are much more dramatic than Felipe was saying. If you look at, for example, productivity in Mexico, and if you standardized in 1983 with the and 1984, the productivity is around 60. And if you look at productivity in Brazil, is the same productivity in Peru. Sort of like increased and then it went back. It's around the same levels as in the 1990s. But it is that we have terrible regulation, and we're basically taxing the formal sector where most of the most productive firms are, and we're subsidizing the informal sector, and that's leading to a huge loss in productivity.
Thank you very much. We have one more question here from Scott. Scott.
Thank you. The keynote speaker gave a great address, and one of the things he said right away was elevated asset prices. And of course, the panel briefly touched on elevated asset prices. Is there anything, and it reminds me, by the way, along Greenspan with the irrational exuberance, which got everyone all excited and then sort of faded out of the way. Is there a tool that central bankers can use to deal with this, or it's not really realistic to deal with it on the governmental level?
The irrational exuberance speech was given in 1996. I think the Dow was at 4,000 or something, and by 4 years later, it was at 10,000. So if I have my numbers right, I think that's about right. So I think, the committee debated after that. They debated what to do about asset prices all the way through the last part of the 1990s, and then the dot-com bubble went away. The conclusion of that debate was that you can't really do anything about it. You don't know when the bubble is going to end. All you can do is clean up after the bubble. And so that was kind of the bottom line of that debate. But now it hasn't been debated for a very long time, and so it's not clear if that would be the same conclusion if you tried to debate that out again. But So that's basically the state of affairs on that.
And there's very little obviously that you can do at the moment when you see the markets. I mean, we don't have tools to deal with that. But probably monetary policy is not completely disassociated with what happens in the markets. And I guess if you have a discussion post the QE, I think that people, at least in Europe, would have a view that much of the QE, if you do a lot of it, if you expand your balance sheet a lot, also contributes to what you see in terms of the prices, asset prices. All around, not only the equity market, but also all other sorts of asset price. So when you do, this is one thing, next time around, when you do QE, you also think a little bit about that, depending also on how this whole thing ends up.
Okay, I think we've basically exhausted the amount of time we've had here. I want to ask everybody to thank our plenary speaker and the panel. Thank you all for coming and have a very good night.